Mainz in London 2016, ladies and gentlemen. With me here is now Dr. Torsten Dennin. He's the head of portfolio management out of Tiberius AG from Zug. And we want to talk about those market movements. Torsten, welcome and good morning.
Thanks, yeah. Pleasure to be here.
Great for having you here as always. And I always really love your market expertise. Well, we had yesterday the OPEC meeting. And they are cutting now the production. What's your view on that?
Yeah, there's lots of volatility in the market. The last weeks I always said that getting short oil and petroleum in general in front of this OPEC meeting probably is a bad idea. The tail risk was more to that we see risks of the deal is broken, but this was not the case. We've seen a cut. But there are also some interesting side notes to this cut. So the price rally yesterday and today, about 10% in total, is quite substantial. So now crude is back to 50, and this is the upper band of our trading range that we propose for the next months.
Okay, great. How substantial do you see the cuts? I mean, we talk about something like 1.4, 1.5 million barrels a day, but is this the truth, or are there some side effects, I would call it? Like Iran, I think they have taken out Iran because they can produce more.
Yeah,
or still allowed to produce more?
Yeah, when you see the total package, I mean, OPEC, it's a very political game. In my last research report, I said it's comparable to the Fed protocol to watch what OPEC is saying.
Yeah.
And especially after September meeting, we've seen oil sentiment improvement, price rallying, but the market was not really in balance. So now if this cut is set to stage, 1.5 million is enough to bring the market back to balance. So it's a substantial cut. The International Energy Agency is estimating, along with us as well, that we see about 1 million barrels per day oversupply in the market. We have very high above 5-year average inventory levels, globally OECD or US levels. So to bring the market back to balance is the first step to balance the market also on the inventory side. But the side note on OPEC is quite interesting to see, because the 1.5 million, it's not very measured in stone, I would say, when you compare the members, Saudi Arabia, Iran, and also the suspension of Indonesia, for example, quite interesting, and also in reaction what Russia will do as a non-OPEC member.
Wow, okay. Now we saw the rising oil price again to $52, something like that. Yeah. Can you imagine that it rises a bit further, and let's say in the light of that all of a sudden the US comes back more in production?
Yeah, we always estimate the US is coming back in the first quarter already for next year with shale. As you've seen, like only a smooth dump in production from the unconventional oil production in the US, and without this higher prices, we estimate that the US is moving from 8.5 to 8.6, 8.8 in this direction, million barrels per day in production in the first quarter. So growing again. Not stabilizing, but growing, but not as sharp in the growth rate that we've seen like last year. So therefore now in this environment it could be that the US is increasing a little bit steeper to bring the oil market back into oversupply. But my thing is, I don't want to quote the US president with his saying, but you have to see what OPEC is actually delivering. So if you see like 1.5 plus 0.6, so in total like 2.1 million barrels, or are we seeing less? I think the sentiment is overshooting. Our friends from Goldman Sachs, for example, they estimate the prices moving up to 60 short term and then coming back to 50. I would say if the price moves up sharply, this is the right time to get out of the energy market, because short term after this the price will correct down, but market fundamentals need more time for a substantial development here.
As it looks like oil is connected now vice versa with gold, because oil is getting up. Gold was hammered again today to 1165, I saw. So maybe then it's time to buy some gold?
Yeah, I call it the Trump trade.
Okay.
So depending on which side you will position yourself. What you see after the election, everybody was a bit scared in the result because it was unexpected, and you saw the first initial reaction was $40 up in gold. Yeah, we've seen prices 1350, 1360 intraday highs in gold. But then after the election results, people, especially like with all the strategists in the world, said now the US presidency to come is good for global markets, it's good for growth, it's good for IP and GDP all over the world. So like a swing from left to right on that issue. So therefore, US equity markets were rallying. S&P 500 is at all-time high, Dow is at all-time high, other equity indices are also up, and the cyclical commodities are up. We talked about oil, but we also have to talk on the industrial metal complex. You saw like on the sentiment trade, copper rallying from 4,500 up to 6, and zinc from 2.5 to above $3,000 a ton in London. Yeah. At the same time, gold and the other precious metals were hammered, and in 2 weeks' time we have the Fed protocol and the Fed meeting, probably raising interest rates about 0.25%, and this will show the debt for gold. Not because when you compare like interest levels on total amount, 0.25% is nothing. But sentiment is trading down the gold and the precious metal markets, and I think we could see a reversion here, like precious metals on the long side and the base metals on the short side. Yeah, because all this, what's getting into the cyclical commodity segments is very sentiment driven, and sentiment when I go down has short legs, right?
That's right, absolutely. No, we really hope for 2017 is getting much better. Can you comment a bit on, let's say, Trump's plans for the infrastructure? I mean, $500 billion, that's an amount of money. And if we go out like what they said, the 10-year plan might be $1 billion even to invest in the infrastructure. How do you think those Trump plans or Trumponomics or however you want to call that will maybe affect like longer term the commodity prices? Because bridges, roads, you are not building out of love and air. You need steel, you need nickel, copper, whatever.
Yeah, you see, for example, the US steel industry rallying, like AK Steel or US Steel. 6 months ago, we are thinking these companies were in serious trouble, and now they're doubled and tripled in value almost in terms of the sentiment about big infrastructure spending. So in terms of details of these programs, this is very difficult. I doubt it that even the US presidency and the newly elected cabinet knows about details yet. So I think this is very early stage, but the volume is quite amazing, and definitely you're right. This is something not a Google or Amazon is taking profit from, but it's copper demand, it's steel demand, all the infrastructure spending. But I think what we've seen here on both sides, on the equity sides for the cyclical guys, as well as on the commodity markets, this is a bit too fast, too much on this side, on the sentiment side. And the medium to longer term effects probably will see like an additional demand for copper, additional demand for iron ore on that side. But we see this effect coming into place about in 6 months' time earliest. Maybe like more 9 to 12 months and onwards.
Yeah. Well, that's okay anyway. So that means maybe we are on the beginning of a new commodity cycle, a bull cycle?
That's my thesis since the beginning of the year. When you talk commodity markets measured by Bloomberg Commodity Index, comprising about 22 single commodities from energy, base metals, precious, and also the X. Never forget the X in terms of diversification here. When you compare like the overall composite index, we've seen like the lows of this index in January and February, and in April, first time we crossed like the 200-day moving average mark. So this created the first time like a positive bullish signal from the technical analysis side, and also the fundamentals for the market overall cleared up. So I really think, and basically since that movement I'm convinced, that the commodity markets saw the lows and have a healthy bottom building, and now look at the beginning of a new cycle looking into 2017 and 18.
Perfect, that was a super final statement. Thank you very much, Torsten. Merry Christmas, and I love that you see the commodity cycle starts again.
Happy Christmas days. Thank you, Bob.
Thank you. Ladies and gentlemen, it was Dr. Torsten Dennin, the head of portfolio management out of Tiberius from Zug in Switzerland. And the new commodity cycle started already. Oil is higher through the OPEC. Gold is down, but maybe vice versa. That might be a good trade within the next weeks and months to have a look at precious metals also, because I think they are not out of favor. They are not out of the hype here. They will come back definitely, and also the base metals started to rise already, but with infrastructure programs in the back of almost 500 billion up to $1 trillion, China and India pushing their infrastructure. I think good times for commodities. Thanks and bye bye from London.